The global electric vehicle race did not slow down, it just fractured, and the break happened in one of the quietest countries on Earth. For years, the EV transition has been framed as a clean technology race, driven by consumer demand and one undisputed champion, Tesla. But the true game was never about the car. It was always about the source code of the electric age, the critical minerals, and the battery supply chain. The sudden, decisive intervention by the Canadian government, a strategic policy that effectively blocked certain high-profile foreign investments into its lithium, cobalt, and nickel sectors, was not a simple bureaucratic delay. It was a perfectly timed economic countermove that has sent shockwaves through boardrooms from Berlin to Beijing, directly interfering with the vertically integrated growth model championed by giants like Tesla. This single regulatory strike reveals a deeper systemic shift. The age of maximizing global efficiency, where a company like Tesla could source, manufacture, and sell anywhere, is over. The new global imperative is national economic security and supply chain control, and Canada, sitting atop one of the world's most valuable caches of battery minerals, just made a historic claim on its own future. What is truly surprising is the sheer scale of the asset Canada is leveraging. The nation possesses significant deposits of the 6 critical minerals essential for high-performance EV batteries: lithium, graphite, nickel, cobalt, copper, and rare earth elements. Global demand for these minerals is projected to increase by as much as 40-fold for lithium alone by 2040, according to the International Energy Agency, IEA. Recognizing this leverage, the Canadian government has committed to a mines-to-mobility strategy, attracting over $40 billion in announced investments in EV production and the battery supply chain since 2020. However, this nationalistic strategy now conflicts directly with the open market principles Tesla's hyper-growth model relies on. When a foreign state-owned enterprise, SOE, investment in a Canadian lithium project, the same mineral Tesla requires to scale, was effectively banned, it was a pattern interrupt. It changed the calculus from how cheaply can we build to how securely can we source. Why should a family in Ohio or a worker in Germany care about a Canadian policy? Because the decision directly impacts the price and availability of every EV everywhere. Geopolitical tension is creating an economic scarcity mindset. When nations hoard or restrict access to their critical resources, it forces all car manufacturers, including Tesla, to pay a premium or completely re-engineer their supply lines. This is the security premium on the new global ledger. It means that the low-cost, high-volume EV that was promised for the mass market now faces an intrinsic, government-enforced headwind. It's a classic behavioral economics phenomenon. The perceived risk of a future shortage, the scarcity heuristic, is now baked into the cost of production today, and that cost will inevitably trickle down to the consumer. Canada's move has not just blocked one deal, it has fundamentally repriced the cost of doing global EV business. It forces the world to confront the reality that control of the mine is now more powerful than control of the assembly line. But the mechanics of this move are far more intricate than simple protectionism. It is a precise geopolitical maneuver targeting a specific vulnerability in the North American supply chain. The move by Canada was not an accident. It was an act of economic judo, using the colossal weight of a geopolitical rival's dominance, a dominance that Tesla currently relies on against itself. The hidden mechanism here is a direct response to a massive global imbalance. While North America and Europe design the cars, a single major power dominates the refining and processing of the raw critical minerals. For instance, more than 80% of all rare earth element processing, which is vital for EV motors, takes place in one geopolitical bloc. Canada's intervention, restricting foreign state-owned investment in its domestic critical mineral projects through the Investment Canada Act, is designed to shatter this monopolistic choke point. By limiting non-allied foreign control, Canada forces the creation of a vertically integrated North American supply chain from the mine to the battery cell. The psychological framing is a shift from globalization to geopolitical bloc formation. Nations are no longer trusting open markets to safeguard their long-term interests. They are building fences around their most valuable assets. The most surprising fact about this geopolitical fence is that it leverages one of the greatest economic policy weapons in history, the U.S. Inflation Reduction Act, or IRA. The IRA offers enormous tax credits, up to $7,500 per vehicle, but only if the EV and its components meet stringent North American sourcing requirements. By actively restricting non-allied access to its raw materials, Canada ensures that its reserves, which are crucial for the production of minerals like nickel and cobalt, are channeled almost exclusively into the North American manufacturing ecosystem. This forces companies like Tesla, which has a significant manufacturing footprint in the US, to pivot away from cheaper internationally sourced components and towards the nascent but highly subsidized North American supply chain. The total value of announced investments in the Canadian EV battery sector, which includes major projects by Volkswagen and Stellantis, is now over $40 billion, entirely reliant on these secure, Canada-sourced minerals. This is how a policy decision in Ottawa becomes a multi-billion-dollar structural determinant for the entire continent's industrial future. For the institutions involved, the stakes are enormous, and the psychology is simple: security over margin. For Tesla, the immediate need is to secure a long-term, high-volume supply of battery materials. A constrained supply chain means reduced production scale and a higher base cost for every unit. For Canada, the national identity is at stake, transforming from a simple resource exporter, a quarry, into a sophisticated, high-tech manufacturing hub. Canada's mining and metals sector already contributes over $109 billion to its GDP. By forcing the processing and manufacturing stages to remain within its borders, it captures exponentially more value, creating hundreds of thousands of high-wage jobs and cementing its position as a strategic ally to the world's largest EV market. The move is a calculated risk: trade one large, immediate but non-strategic foreign cash infusion for decades of secure, integrated economic growth. The immediate fallout is clear. Tesla's global blueprint for frictionless expansion is facing its first genuine continental challenge. But here's the part nobody expected. This policy isn't just about minerals. It's about a fundamental technology gap that Canada is actively working to close, changing the EV race from a sprint into a technological marathon. In the global EV race, Canada just unveiled the quiet truth: the fastest car doesn't win. The one with the most secure pit crew does. Other markets are watching this Canadian move with intense scrutiny because it offers a playbook for navigating the current global economic fragmentation. The European Union, for example, is also racing to secure its own battery supply chain, but it lacks Canada's vast and untapped reserve of critical minerals. For nations like Germany and France, the challenge is structural. Their industrial might is built on a century of internal combustion engine manufacturing, requiring a traumatic shift to new technologies. By contrast, Canada's strategy of leveraging its mineral wealth is seen as a way to leapfrog the established industrial powers, moving straight to a high-value mine-to-battery ecosystem. The global perspective is one of resource envy and strategic emulation. Nations realize that raw mineral resources, long considered commodities, are now functioning as geopolitical currency. This strategic pivot finds its historical parallel in the post-war era, specifically the establishment of secure oil supply lines by allied nations. Resource control has always been the foundation of military and economic power. The surprising element is the speed of this transition. Just a few years ago, the mantra was global free trade. Today, the national security exception is being used to justify market interventions worldwide. This is less about fair market competition and more about what systems theorists call supply chain resilience, the ability to withstand a global shock. Consider the semiconductor shortage that crippled auto production post-2020. It cost the global automotive industry hundreds of billions. Canada's move is an attempt to inoculate the entire North American EV sector against a future, predictable mineral shock. They are sacrificing immediate investment for long-term industrial self-sufficiency, a behavioral insight driven by the universal human tendency to overweight the pain of a recent major loss. In this case, the loss of control over the supply chain. How do other markets view Tesla in light of this? With a mixture of awe and caution. Tesla's brand is an exercise in psychological anchoring. It sets the expectation for what an electric car should be. But its incredible efficiency has always depended on a frictionless, globally optimized supply chain, which the Canadian policy is now friction loading. For the average investor or competitor in places like Korea or Japan, which are deeply invested in battery technology, Canada's policy signals that the window for simple commodity-based trading is closing. Future deals will require not just capital, but a commitment to onshore processing and manufacturing, a forced technology transfer that protects the national interest. This creates a powerful incentive for allies to deepen their integration, such as the US-Canada Battery Alliance, ensuring a shared, secure supply. The Canadian intervention is a declaration of economic sovereignty. It's forcing Tesla and others to redraw their global maps based on political risk, not just labor cost. This is already having a cascading effect on where the next generation of EV factories will be built. But it gets deeper. The biggest threat to Tesla's expansion isn't just Canada's minerals, it's an upcoming, more powerful policy move that weaponizes North American consumption. The silent policy maneuver in Canada didn't just interrupt Tesla, it created a new, undeniable economic moat around North America, and your next car is trapped inside it. The real-world impact flows directly from the intersection of Canada's resource policy and the US's financial incentives. For the North American worker, this move translates to tens of thousands of secure, high-paying jobs in battery assembly and component manufacturing. Before this strategic pivot, Canada was a resource exporter. Today, the government is incentivizing the high-value midstream processes, the refining and chemical conversion, that currently represent a massive gap in the Western supply chain. For example, while Canada has ample raw nickel, the creation of battery-grade nickel sulfate, a crucial cathode material, requires significant processing infrastructure. The policy effectively acts as a forcing mechanism, channeling billions in tax credits and investment into building this midstream capacity within North America, creating a closed-loop system of economic activity. The psychological impact on workers is a powerful sense of industrial reshoring and security. The part the media isn't discussing is the long-term, destabilizing effect on the global EV market structure. By forcing Tesla and its competitors to use higher-cost, secure-source materials, Canada is inadvertently setting a new, higher global floor price for the EV. The promise of an ultra-cheap $25,000 EV becomes economically challenging when the fundamental input materials are sourced to meet a geopolitical, not commercial mandate. The behavioral implication is a massive acceleration in the development of alternative battery chemistries that rely less on highly contested minerals like cobalt. The price signal from Canada's resource restrictions is a powerful economic catalyst, driving billions of dollars into R&D for sodium-ion or solid-state batteries. The surprising fact is that this protectionist move, intended to build a national champion, may ultimately accelerate a technological disruption that benefits the entire planet. What does this mean for the average family budget and market stability? In the short term, prices for all EVs remain high due to both high demand and the increasing cost of securing essential inputs. But the long-term picture is more stable. By creating a fully integrated domestic North American supply chain, Canada and its partners are building an industrial fortress immune to overseas political shocks. This reduces the risk of the catastrophic price spikes or multi-year delivery delays that plagued the industry during the supply crisis. The market system shifts from a highly efficient, single point of failure model to a redundant, resilient one. The trade-off is higher initial costs for vastly increased stability. Canada's quiet move on critical minerals did not just shift the global EV race, it fundamentally changed the economic operating system for every major automaker. It redefined what secure growth means in the new fractured global economy. It has forced a giant like Tesla to confront its deepest supply vulnerability, because while everyone is focused on the price of nickel and lithium, the real, undeniable shift is already happening in an entirely different sector, a sector that supplies the raw energy needed for all those new factories, and it's a transformation that will determine the true winner of the EV race.